All right, let's dive into Asana's latest earnings report. On September 3rd, they dropped their Q2 numbers, and wow, the market reaction was fast and loud. So, what's behind the big jump? We're going to break it all down for you.
So, right out of the gate, the market absolutely loved what it saw. The stock shot up around 8% in after-hours trading. Now, that's not a small move. That's a really strong signal that investors were impressed with this report.
And that really brings us to the big question, right? What exactly got investors so excited? Well, we're going to find the answer by looking at three key things: the hard numbers, the bigger story they're telling, and, of course, the potential risks.
Okay, so first things first. The simplest reason for that pop? Asana just flat out beat Wall Street's expectations. This wasn't a squeaker either. They really hit it out of the park, signaling some serious operational strength.
Let's take a look at the actual numbers here. Revenue came in at almost $197 million, which was nearly $4 million higher than what analysts were expecting. And on the bottom line, non-GAAP earnings per share landed at 6 cents, a penny ahead of the consensus. That's a really solid beat on both the top and the bottom.
But, it gets even better when you look under the hood at profitability. Asana's non-GAAP operating margin grew by 16 percentage points compared to last year. A leap that big is huge. It shows the company is laser-focused on growing efficiently and profitably. And that profitability isn't just some number on a spreadsheet. It's turning into actual cash. The company generated over $35 million in adjusted free cash flow. That's real money, strengthening their balance sheet, and it's one of the best signs of a healthy, disciplined business. And one last number to round out this picture, and it's a key one for growth. The number of customers spending over $100,000 a year with them, that grew by 19%. This tells you Asana is successfully moving up market and winning those bigger, more stable enterprise deals.
Okay, so beating expectations is great, but an 8% jump? That tells you there's more to the story. There's a narrative that's really grabbing people's attention. And for Asana, that narrative is all about their AI growth story. This is what's really firing up investors' imaginations. At the heart of their whole AI strategy is this thing they call the work graph. It's basically their secret sauce. See, most AI tools start with a blank slate, but Asana's AI already understands how all the tasks, projects, and people are connected. Management argues this is their massive advantage for building AI that's actually useful in a business. This is the big vision laid out by the new CEO, Dan Rogers. He's not just talking about little AI helpers, he's talking about an agentic enterprise, a future where these smart AI agents are like digital teammates, handling complex jobs because they have all that context from the work graph. So how are they going to pull this off? Well, they've laid out this really clear three-part strategy. First, there's AI Studio, which is like the workshop for building your own custom AI flows. Then you have Smart Workflows, which are the ready-to-go templates. And finally, the future vision is Teammates, those super intelligent digital collaborators. It's a very logical, step-by-step plan. Now, this isn't just talk, right? It's already making them money. The recurring revenue from AI Studio more than doubled in just 1 quarter. And they're giving real-world examples, like a customer who's saving 15,000 work hours a year. That's the kind of ROI that makes a CFO sit up and pay attention. All right, it's super easy to get caught up in all the AI hype, but a good analysis means looking at the other side of the coin too. And to their credit, management was pretty upfront about some potential challenges they're seeing on the horizon. So let's put it all on the table and balance things out. On the plus side, you've got that incredible AI momentum, fantastic financial discipline, and they're making progress on FedRAMP, which could unlock a ton of government business. But on the risk side, they're seeing some pressure in signing up new small businesses, they've got a big batch of renewals coming up with tech companies, and overall growth, while still good, is slowing down a bit. Okay, so we've looked at the numbers, we've heard the AI story, and we've acknowledged the risks. Now, let's pull it all together for the official Talk Tickers take. What should we really be watching for next quarter? First, let's ground ourselves in what the company itself is promising. And what's really crucial here is that they raised their guidance for the full year, for revenue, for earnings, and for operating margin. That's a huge vote of confidence from the leadership team. So, putting it all together, here's the Talk Tickers thesis. We're predicting Asana will meet its Q3 guidance, but the number everyone's going to be watching is net retention rate, especially with those big tech renewals coming up. For the stock, expect it to keep bouncing around. The bull case is all about AI, while the bear case is focused on that small business slowdown. This balance leads us to assign a market perform rating. The big question is this:
Can that AI engine ramp up fast enough to power through the slowdown in their core market?
And just to wrap things up, we have to say this, and it's really important. This is not financial advice. This explainer is for informational purposes only.